Amazon is one of the most successful stocks and businesses out there. You may say 5 years, 140%. I've seen better. That's true. I have also seen better. However, if we zoom out, it starts looking very impressive very quickly. A decade ago, January 2015, this stock was somewhere between 17 and 19 per share. We are now at 226. This is an incredible run. They're a company that's grown revenue and profit at crazy levels over the last decade plus even. Over the last 5 years, we've still outperformed the market. S&P 500 is about up 90% over the last 5 years or so. Maybe if you factor in dividends, which Amazon does not pay, it's a little closer, but this is still a company that's done very good. Not to mention they had highs in 2021. If you bought exactly 5 years ago, you would have been up pretty quickly. Also, lows in 2022 where you could have bought in as well. Also, maybe not fun to hold through that, but still. In 2023, we're at 86 share. Now we are at obviously 225. This is a company that has done very well. Maybe you know a lot about Amazon and you just want to re-go over some of the details on the stock, want to hear my opinion on it. That's cool. But also, if you don't know much about Amazon in terms of the stock, in terms of exactly where the profitability is, where the revenue is, how fast they're growing, I'm planning on covering in this video. So hopefully, whether you know Amazon very well or not much at all, I can help you learn something or refresh your mind on some of the stuff. Of course, it's vitally important to actually understand what a business you're investing in actually does, and I know all of you know about Amazon. All of you know the retail side of things, but they do have a couple different components to their business. Of course, the retail side of things, we all know about that. You buy stuff, they ship it to you. That is generally their higher revenue side of things. They do a lot of revenue in that, but the profits on that are razor thin, if not sometimes unprofitable. So that is a big element of it, and that's kind of what they built their brand on. But they have some other things, Prime Video, for example, that generally has higher profit margins. Of course, they're pouring a lot of money into shows, maybe too much money, but they are, and that's trying to build up subscriptions. Because if you have subscriptions, obviously they're pouring a lot of money in now, but eventually you'll just have people subscribe to you, and that's just recurring revenue month after month, year after year. Investors like that, businesses like that, because it's stable and you can kind of count on it. Of course, it can always drop, and then you can kind of view Audible in that same area. Of course, it's kind of a blend because that comes from they grew on selling books and things like that, but still, that's a higher profit margins generally. And then you have almost a second or adjacent category with higher profit margins, which is Amazon Web Services. Amazon Web Services has been growing fast. Its profit margin, like I said, is much higher. It's doing very well. That is a very key component of their business, and honestly, that the latter stuff outside of the retail, of course we want retail to do good, we want that to do good, but as a long-term investor, we would want them to really key on and growing that earnings per share as quick as possible, and that would primarily be focusing on that Amazon Web Services side of things and subscription model as well. Just taking a quick glance at Amazon's PE, it doesn't strike you as, oh, this is a stock I need to buy. However, there's more behind the scenes, but let's just address the issue first. 48.5 PE. That is relatively high. The S&P 500 is right at about 30 PE. There's plenty of other even Mag 7 companies you can get around that level. Apple's a bit above it, but Meta and Google are even slightly below it right now. And then the forward PE as well, 44 compared to the S&P 500, which is at about 23. So that tells you this is a company that is valued above the S&P 500. There's one thing you usually should check, non-GAAP versus GAAP. Just make sure there's not one-time expenses, or maybe it's more generous than it should be, affecting the PE. So that's always important to take a look at. We don't really have that here. We can see it's roughly the exact same. So nothing really there. But the reason it's really not too concerning to me is, well, if we look back, we're going to look in the future, but they've over 2.5x their profit over the last 5 years. Companies do not do that. That's not near the normal growth rates that companies do. It's clearly abnormal, and that's going to have an abnormal above average valuation. You would expect a company that doubles the S&P 500, or what you'd expect the average company to do in a 5-year span, roughly, 70 to 100%, depending on the year. Of course, no recession, but it's a very, very good performance on one side of it. But also, you're probably expecting that to roughly, just looking at it as a whole, they do 650, so they're expecting $620 billion in revenue. That is crazy. You can almost view Amazon as two separate businesses, the retail side of things, and then the Amazon Web Service. Honestly, you could do it maybe three. They have Amazon Prime. You got subscriptions from that. Then you have, Audible subscriptions, things like that. That's high profit margin business, high profit margin revenue. You're just going to get higher revenue off that. And then, of course, retail's razor thin margins. And then you maybe have a third offshoot, Amazon Web Services, which is, in terms of revenue growing year over year is phenomenal. In terms of profit margin is phenomenal. It's just very, very, very good. So we'd expect in the long run, if you can keep increasing those higher profit margin businesses, which is what they seem to be doing. And you can see this across the board with the Mag 7. I've covered videos on Meta already. I've done videos on Microsoft already. They are growing profitability faster than they're growing revenue. Not that the lower margin businesses suck. We still want to grow revenue there. But if we can focus on the higher profit margin businesses and make it a bigger overall portion of our pie, then we're going to increase earnings per share faster, which of course we're looking for more money quicker. So we can see revenue. Nothing here concerning. And we're going to look deeper at this a little bit further back later. 9.5% year over year. 12%. 11%. This is growing like you would expect probably the average company to in terms of revenue, but you're getting much more than that in earnings per share. And also 2020 and 2019 were very, very good years for businesses. Certainly the large ones, maybe not the small ones. There's plenty of, I'm not trying to say small businesses were doing well, they were not. But unfortunately, or fortunately, however you're viewing it, it helped the big players. And Amazon benefited, so a lot of growth happened in 2019, 2020, and the fact they're still continue to grow like a normal company did. There's plenty of companies that did not grow like the quote-unquote average company in any average given year, 9.5% to 12%. And they grow earnings per share quicker than that as well. We can see 3.24 up to 5.15. This is great. This is good stuff. It really is. Now they had one unprofitable year. That happens, whatever. Who cares? So, but yeah, there's nothing here with the earnings. PE. The PE is higher, but if you're wanting to own one of the most successful companies in the world that does $620 billion in revenue, you are going to have to probably pay a premium. Now, if you're patient and waiting for it, you can probably get it much cheaper sometime in the next 5 to 10 years. I would actually guarantee you could do that. However, will it probably be much higher than when you buy it at this price? There's also a very good chance of that as well. You're going to have to pay a premium for great businesses. That's just the reality of the stock market. Or you're going to have to be a very patient person. But if you're watching this video, you'll probably fall into one of two camps. So one thing I'm seeing here is Amazon is a bit of an outlier with the other Mag 7 stocks. Specifically because a lot of its business is the retail side of things. So they've grown a lot different than a company like an Apple or a Microsoft. And one thing they do have different is their debt levels. Now, two things can be true at once. Their revenue. Their revenue is extraordinarily high, right? $574 billion in revenue. So when you say, okay, $85 billion in debt, that isn't super alarming. However, one thing you do have to factor in, operating income was only $36 billion. So total debt, $85 billion. That's actually fairly substantial. Certainly when you're looking at tech stocks usually do not require immense amount of debts, and usually, at least from what I've been looking, the larger ones, once we've covered on this channel, not that there isn't any, but generally their debt is not double their income within a year. Now, within a year or two, honestly, usually it's lower than their income within a year, but it still isn't a crazy concerning level. And certainly when you factor in 2022 was just not a good year profitability-wise for them, I give them a pass. I don't think that's super... and you're growing revenue normally, right? And let's look at this. So we were at $14.5 billion in 2019 of operating income. Now we're at 37, just under 37. So you're over 2.5xing in this time frame. That is phenomenal. That is incredible. A lot of that is Amazon Web Services, but there's other factors in that as well. Revenue has slightly over doubled, I believe, if I'm doing that off the top of my head. So you've done very well. You've grown revenue, you've grown income, like I said, 2.5x, and debt in that time. If we look at that, debt has not 2.5x'd. It hasn't even doubled. It doubled for a little bit. Now it's less than double. So The trend is good in terms of that. Now, it's not even that big of a deal, but if we're talking about things we are like fundamentally concerned about, it's something like, okay, we have more debt than profit we make within a year or 2 or 3. If depends on how much you're looking, but because this company is growing so much and because they have that retail side of thing, which just has immense amounts of just things being sold and very little margins being made. It's just a unique business. And this debt, they probably need it to get to where they are. So it doesn't really concern me, but it's something to just factor in and say, okay, this is a company that has, and you should factor then with rates and all that. Okay, our rate's going to be terrible for the next 4 years. That should factor into your valuation of Amazon. It probably should. So, but I'm not super concerned about it, certainly when you're looking at how fast they're growing. It really is pretty incredible. So we can see total current assets, that looks good. Total assets, good. Liabilities increase, but at the rate you would expect it to. So I'm not really seeing anything outside of, like I said, we had that 1 year that really wasn't particularly great, right? We had to borrow more, and we had to borrow more in a time that isn't necessarily great to borrow. So we would have preferred to not have to do that, but that's just the reality of it. And it doesn't seem like it's a company that got particularly hurt from it. This is Amazon's last quarter, what they brought in, and then we're going to take a little bit look at what they took out, right? So 159 billion coming in last quarter. First off, that's just crazy. But you understand why a lot of it is the retail side of things. So you can kind of break it into 2 or 3. Let's just cut it down the middle and break it into 2. This is more the retail side of things. So online store, Amazon store, 61.5 billion in revenue, 7% year-over-year growth. That's not bad. You want this to grow. You want all this to grow. Physical store, 5% year-over-year. Third-party seller services, 10% year-over-year. So you want to see this increase. However, this is not where the profit is long-term, in my opinion. It's important. You want this to grow. You want this to grow quickly. However, you're going to see profit increase faster than revenue. And that's primarily because you're seeing this increase. You're seeing earnings per share grow faster than revenue. Because the more you grow this, look at this, 19% year over year. That's advertising. Subscription services, 11% year over year. Amazon Web Services, 19% year over year. Other, we're going to ignore that. But this is where you're going to increase earnings per share dramatically. If you increase revenue on this, you're going to see earnings per share shoot up. And this is where a bulk of the focus is. This isn't bad. We want this to grow as quick as possible. And maybe someday we'll be able to increase margins dramatically on that. But this is really where they're keying in on. There's a reason they're spending so much money in investing in Amazon Prime Video, in, subscription services, and certainly Amazon Web Services. Because you get just the margins is so much better. So they're trying to pour money into it, and they can subsidize it. They do so much in revenue. They can afford to pour. I mean, we got 15.3 billion profit at the end of it. But when you're talking about total revenue, it doesn't seem that impressive. But if we can continue to increase Amazon Web Services 19%, advertising 19%, subscription 11%, you're going to do very well. You're going to do very, very well long term. That's what I'm seeing. So, and that's not to, like I said, not to say that's not important, but if this can be year over year 10 plus for 5+ years, you're going to be looking at Amazon saying 45 PE, who cares, dude? Look how much they've grown. I always like to take a look at historical PE in this video just to kind of get an understanding of where the stock trades. For Amazon, it's actually pretty interesting and very difficult. So they haven't really been that profitable for quite a while, and that's not an issue. And you may ask, why is that not an issue? It's because they're growing revenue quickly and they're growing profit quickly. So we can see, basically, this is one of the lowest the PE ratio has ever been. It's been in the 90s, 70s, 60s. Now we're in the 50s, mid 40s. Okay, that doesn't necessarily mean it's cheap because we probably aren't growing earnings per share quite as quickly as we were. When you're just becoming profitable, it's much easier to grow PE many multiples because you really only have to increase margin slightly. And you can be making a profit but just pouring money into R&D or advertising or something like that, and it's a quote-unquote loss, right? You can be, if I'm selling $100,000 in donuts, right, and I'm making 25,000 in profit, but I'm taking that 25,000 and doing it in signs around the city, right? I'm not really making any money. I'm technically break even, but you're making money. So it's really hard and difficult to judge just off PE of a company that's just becoming profitable. But Amazon, we're starting to get the point where we can do that. And so, but actually, if we're just looking at historical PE, like I said, we're actually relatively low. And if you see how much they have been growing profitability, it's really not that surprising. So this is a company going off historical PE. It's not something you're like, oh, this is expensive. It's really not, even though, like I said, we're in the high 40s. But this is probably going to be a company that's going to continue to grow earnings per share fast if they can get that profit margin up. There are risks and advantages every company has, and it's important to discuss them before investing in a company so you actually know what you're getting into. Every company has them, and of course, I can't cover every single risk in this video, so if you have any important ones you think I didn't address, feel free to ask down in the comment section. I would like to address the point. Amazon specifically. So, I've talked about it many times in this video, but retail, lots and lots of revenue. A disadvantage from that is that you only have a few points of margin. So if you lose that, you can have a bad year and you can have one quickly. We can see that. We saw that in 2022. And it wasn't just bad for them, it was bad for plenty of companies, but it was specifically bad for Amazon. And it was just not a good year. You can see that in the revenue, you can see that in the profit. More so the profit than the revenue, actually. But it just wasn't a great year. So even if you just lose a few percentage points of margin, that can be billions and billions of dollars. It really can. Inversely, if you just increase that slightly and you're just, 2% more efficient on retail, that's a lot of money as well. So that actually can be an advantage. But it's really hard. There's only so many ways you can automate. I mean, we've heard them float the idea of delivery drones around forever. You just require a lot of people. I mean, they're one of the largest employers in the United States. And you can hear by, it's not a very good place to work. Part of the reason is just they're trying to cut margin down. Right? It's just so labor intensive. And you see that in Walmart. You see that in every single retail business. It's just so hard to make money. The good thing is they do a lot of sales though. So that's the main risks I see. I mean, you could point to a couple other small ones, and specifically with the web services side of things, I don't think it's any risk outside of the key ones you see for the other Mag 7 stocks they're investing, like a Meta or a Microsoft. Of course, if they lose out on AI, another company does really good. Let's say Meta hits the home run, or Apple. That's going to be difficult, or Microsoft. That are probably the most likely. That's if you lose out big, that could be very bad. I know, of course, they have other cloud stuff. It's not just AI, but all these companies are investing in AI pretty heavily, and it would suck to lose out on it. And I guess if it's just not as big as you think, they pour a lot of money into it. But I think that's not a big deal for Amazon. The last risk I see is, I'm blanking on it. Oh, it's the debt. Yeah, it's the debt. They have a lot of debt compared to how much they bring in profit, but because of how much revenue they do, and it's really nothing to worry about, but it's a little bit higher than you would like to see in a tech company, in my opinion, but whatever. And then the last advantage is huge moat. Huge moat. Certainly on the retail side of things, hopefully on the web services side of things, and that continues to build. But, I mean, they've actually killed quite a lot of competition. You feel bad for the small businesses, right? I'm not trying to be non-empathetic. I'm not trying to be non-empathetic, but it has built a very large moat for them. It really has. When you think of, I need to order something online, you go to Amazon, and you can probably find it. I'm not the biggest stock projection guy on this channel. I don't particularly like doing it, but I think it's important to cover in these videos to kind of give you guys an understanding of what I personally feel that the stock is going to do in the future. Of course, absolutely no guarantees. I cannot see the future. I'm not clairvoyant. However, I think betting on Amazon long term is not a bad decision. Right? We've discussed things over and over and over and over. I've just hammered profit margin in this video, but that's the most important thing. If they can continue to increase profit margin the way they have been while increasing revenue, like a normal company, they're going to do very, very well. They're going to do very, very well. They have been doing very, very well. Clearly. I mean, look at this performance. It's not shock to any of you guys. 2015, they're at 31. They're at 225 now. That was middle 2015. Earlier, it was closer to 20. That is just phenomenal. Obviously, the last 5 years it hasn't been quite as dramatic, 140%, but it's still good. And there's many opportunities you could have bought. If you bought exactly 5 years ago, you would have done well shortly thereafter. And if you bought at lows in 2022 or near 2023, whatever it may have been, you would, even here, middle 2022, you would have been very profitable in what, year, 2 years, 2.5 years, something like that. That's not, it sounds like forever, but when we're talking in terms of long-term investment, it's really not. This is a company that's done well. Amazon is going to continue to do well. Now, into the far, far future, who knows? I'm not going to say they're going to 2.5x earnings every 5 years for the next 50 years. That'd be crazy. Not that it couldn't happen, but it would be rather crazy. We haven't seen growth like that consistent for long periods of time, and they're getting to the point where it's harder and harder to just continue to grow at crazy rates. However, I do think there is a very, very good shot that this company continues to grow above the S&P 500 faster than the market does. They have a track record of doing so. Like I said, I think there's room for their margin to increase. Their higher profit margin businesses are continuing to increase at high rates, very high rates. So it's not a crazy bet. I think you would be crazier to say it's going to underperform. However, I still understand if this PE multiple is too high for you. I understand the risks are like that, but I think Amazon will be fine. I do. I think they're going to outperform the market, maybe not dramatically, but substantially over a 5 to 10 year period. Of course, recessions happen. They hit areas differently, even though Amazon's probably not. So they'll be hurt, but it wouldn't be like crazy bad. But anyways, that's all I really got for this video, guys. If you enjoyed, I appreciate if you liked or subscribe. If you made it this far, I know you did. I do daily stock content on this channel. I cover all sorts of stocks in depth, and I do compilation videos. If you want to check them out, of course, just hit the videos on my channel. I do them daily. I do daily stock content on this channel. But I appreciate all of you for watching, and I'll catch you next time.